Welcome you all to the 15th edition of India International Gold Convention. Ladies and gentlemen, a very good afternoon to all of you. Vanakkam, Sasriyakal, Namaskaram. We will begin the first masterclass titled Using Gold Options in Bullion and Jewellery Business, which is a case study. The speakers for the session are Mr. Shivanshu Mehta, Head Bullion MCX, and Mr. Hemant Thukral, Derivative Expert, Aditya Birla Money. Would like to let you know that Mr. Shivanshu Mehta will be connecting to us through Skype as he is not available with us here. Now, kindly place your hand together for Mr. Shivanshu Mehta.
So all members of this August gathering representing the Bullion and Jewelry fraternity, I welcome you all on behalf of MCX. And I understand a little bit of delay, progressive delay in people checking in, but we'll begin anyhow. So joining me is Mr. Hemant Thukral, who is a derivatives expert who deals with the subject of options. And this session is solely going to be talking about how physical hedgers in bullion can utilize our recently launched options offerings. As you're aware, we launched options on 17th October in gold futures, and subsequently we have 5 different products, including silver. And the idea behind this presentation will be to showcase those specific strategies which hedgers across the world use to further augment their hedging activity, which they are conducting with futures and the spot market. So as you're aware, the underlying futures on which our options product is based, I just wanted to discuss very quickly the specific advantages that brings to the table. Over the past decade and more, as you're aware, MCX today is a sort of a benchmark wherein the bullion value chain pricing is done MCX plus or minus. It has a 3-component hedge. It has the gold prices as well as the currency and the custom duty. So you get a complete comprehensive cover by way of using MCX futures. It has a very strong correlation with international prices as well as the domestic spot prices to the tune of 99% odd, which takes care of hedging efficiencies. And as you're aware, the trading hours in India being so geographically placed, we have the advantage that our working trading day takes care of movements from Japan to China to Europe and then the US markets. And post that is when MCX shuts for the day. Deliverable contracts, we have compulsory delivery products in gold and silver, following the international standards of quality. So while you can try and connect Hemant, I'll begin this topic. So options as such are different from futures in the sense that you have a right but not the obligation to exercise a certain position. You, in short, can actually profit while maintaining a leak-proof hedge. You can profit on the favorable side by using options, and you can pay an insurance premium to do the same. That is, in essence, how options and futures are different. Using futures, you can only offset your positions at best, at no profit, no loss. So there is an agreed future expiry date. There is an agreed strike price. And what is actually traded is the premium. The premium is, in all senses, just like an insurance premium, which you pay to get a certain cover. Hemant, are you able to view us and hear us? Okay, so I think you remain there. The connection is a bit poor, so I'll progress with this. And when we come to the strategies part, we'll take your cue once again. Okay? So in options, a call buyer basically acquires a right to buy at a certain price, and a put buyer acquires the right to sell at a certain price, say 30,000 rupees per 10 gram. And what changes hands, like I said, is the premium. Yeah. So here is some of the ways in which international users of bullion, like miners, and international bullion players utilize pure hedging techniques. the collar, the costless collar, which is the first one explained there, you basically cover the ceiling as well as the floor. You're basically selling calls above the money, and the premium which you get from that, by that you're actually buying puts below the money, thereby protecting yourself across a range of prices. This is something which is followed internationally by various mining companies who sell their unmined production, which is budgeted to be mined over the year. The second is flexible pricing schemes which jewelers run, and over the past 1 year, many of the jewelers in India, branded and unbranded, small and large alike, have started using our options for this type of a mechanism, wherein during the course of a season like Diwali or Akshaya Tritiya, the walk-in customers are offered the price of today or of the festive occasion, whichever is lower. And they are able to do this by using the puts available at MCX. So if there's a walk-in customer today, you offer that price, you buy a put the day on which the seasonal festivity is there. If the price goes lower, you earn money from the put and you're still able to offer that price. If the price goes higher, then buying the put simply becomes an administrative cost of this running this scheme at, say, just about less than 1% of the premium which you pay of the value. The third is inventory hedging, wherein with options you're actually able to monetize your inventories. Because in the case of futures, like I mentioned, you offset your positions. Here, there is also an additional premium available to you. So depending on the level of volatility in the market, the premium fluctuates. And just like it's more difficult for a person who's slightly older to get a medical insurance because the premium is high. And why is the premium high? Because there is a high risk. So at different points in time, when there is a different risk perception, can you go to the next slide? So when there is a different risk perception in the market, the premium fluctuates. So it makes more sense when the volatility is high to hedge by way of writing options and gaining that premium. And when the vols are low, it makes more sense to buy calls and puts to conduct your hedging activity. So if you see in this chart, the orange line is the implied volatility. What is the perception of volatility going forward in the market? That's called the IV, or the implied volatility. And you can see that every time there's a beautiful inverse relation. So 9 out of 10, when the vols rise, markets typically fall. So you can see that in the chart, the orange IV is rising, and at the same time, the price of gold, which is in the green, you can see it's falling, and vice versa. So probably at those peaks, when the vol was very high, it made more sense for call writers or put writers to actually come and eat away that premium against the physical stock which they hold. Just like in the equities, you have option writers who hold different equity scripts. Here you're dealing with physical gold, and there is a sense of monetization of that physical gold by way of this activity. So to summarize the few of the features, it's like a price insurance. Yeah, we've got, Hemant, are you back now? Are you able to? Excellent. So you can take it from here. The strategies are yet to begin anyway.
Okay, first of all, as Shivanshu said, it's a complete unforeseen event that I could not make there directly. The idea here to join new people was to make understand that what options as a thing has done a huge difference. What options can bring as a huge difference to the table, especially for hedgers and people who hold physical gold and people who hold inventories. So that was the main idea to get in touch with people. So I will just go through the strategy parts because I think initial part has been covered by Shivanshu. So strategy parts, if we go to this strategy slide where it is option usage by physical people. So we can take that slide there.
Yeah, 1 second. We are just getting the PPT on. There's some issue. Hold on, please. Chart about the implied volatility and its inverse correlation with the price. So you can start from there. You can start talking from there while they upload it.
Okay, so basically, the role of VIX is very important when it comes to pricing of the underlying. See, we have to first understand what is volatility all about. Volatility is about an uncertain environment, an environment that is not being able to predict or that is causing the uncertainty. That will lead to the most of the time that it has a negative correlation with the underlying. So anytime the underlying starts to move down, we will see the risk start to move up because it's an uncertain environment which leads to corrections. See, I'll give you one example. Whenever we see an event coming in, or whenever there is a budget coming in, we see people hedging, we see people offloading the positions, we see people cutting down the positions. That is because people are not certain about the environment. So if a VIX has to move up, it will move up because of an event, because of unforeseen event or a foreseen event. And whenever that happens, it has a very big negative correlation with the pricing of the underlying. But when it comes to a pricing of an option, actually the volatility means the option prices starts to move up, especially the put side, the hedging side, because of the volatile environment. So the VIX has a perfect correlation with positive correlation with option prices, whereas a negative correlation with the underlying prices. I will, till the PPT gets up, I will explain you the very simple example, a real life example that we do on daily basis. We all watch cricket in our life. See, cricket is like a religion to India. So I think we can all correlate with cricket easily. So if two people, whenever we name cricket, betting comes immediately to our mind. Now, assuming that two people are betting on a cricket match, let's see that situation. And then we will come back to volatility and the option pricing. So if two people are sitting and they bet that one bets that India in first 5 overs in a T20 match will score 100 runs. The second person says it is impossible. India cannot score 100 in first 5 overs. So if India scores 100, I am ready to lose 500 rupees. So the A person says, okay, if India does not make 100, I will give you 500. So just see the simple example. Two people sitting in the front of the street betting that whether India can score 100 runs in a T20 match in first 5 overs and 500 rupees is the bet. Now, then the situation starts. After 2 overs, if India scores 45, what is going to happen? Now, suppose that the person who had betted that India will score 100, he gets an edge because first 2 overs, 45 runs have been scored. So suddenly, the person who is losing or the person who felt that India cannot score 100, he will approach the first person and say, I feel that the bet is going against me. Can we settle it for 150 rupees? So just imagine, after 2 overs, neither the 5 overs have happened, neither it has come to a conclusion that India scored 100 or not. Still, there is a premium to that option. There is a premium attached of 150 rupees. Now, just imagine, do you feel that the person who has betted for 100 runs will actually close this bet at 150? The answer is no. He will not close this bet. He would like to proceed with the bet because he feels there is a chances of him winning a lot. So now let us see after the situation of third over, India going great runs, suddenly loses 2 wickets, and in that over they can only score 10 runs. That means after the third over the score is 55, and he has lost 2 wickets. Now what has happened? The situation has changed. The volatility has come in. Now the second person also feels that he can also win. So now the first person goes to the second one and says, yeah, you are giving me that 150 rupees, let us settle the bet. Now, do you think the second person will settle? Again, the answer is no. Because now he thinks that he can also win. So now the situation is different. So he will say, let's settle at 100 rupees. So if you see what is happening right now, the situations are changing depending on the volatility, and the bets are changing without anybody waiting for the fifth over to end, or without even seeing that whether India will score 100 or not. So now correlate this example with the options.
And you're back on, Hemant, so you can use the PPT now. You can start with the strategy slides, this one, numerical examples of fixed gold onwards.
Yeah, so I was coming to the examples of basically I was explaining that how the volatility can hit the options. So without even the contract reaching the volatility can lead to a huge premium discrepancies. So volatility can, and that volatility we are here to tell you that how can we use for hedging purpose and avoid that volatility. So if you see the slide, there is option usage by a physical gold, by a physical debt, and it's the first is producer bullion dealing hedging. It says anybody who is a dealer, how it can hedge. And the first strategy is given as collar. Now in this what happens is the gold producer will buy puts which is out of the money and will sell calls which are out of the money. So the idea is that supposedly today gold is trading at say 30,000. So if you feel that gold can go further down from here, so he buys a put of 30,000. At the same time, if you expect that it will not cross 35,000-40,000 on the upside, he will straight away start selling 31,000 calls, 30,500 calls. So what it will help is not only gives him the hedging on the downside, the hedging is funded on the upside by selling that call. So if you see the collar graph which is there in the slide, you see that the downside is completely protected and the upside is getting locked because of selling that call. So the idea is to hedge the positions and hedge it from an unforeseen event. So this strategy is used by people, especially when there is an event, a budget, where a duty that can be announced, anything which can hit the inventory. At that level, the strategy can be utilized. What is the other situations where the strategy can be utilized? If you see, the other situation is for people who are offering flexible pricing. Lot of jewelers today, especially when the time of auctionability or when the time of festival comes, they are offering flexible pricing to the people who come in. So what happens if people visit today, they book, but they take delivery after 2 days. So what to do now? Because today they are offering the prices may change after 2 days when they come for delivery. So what you can do is you can buy goods on today prices, so that if there is a slide further down, you can hedge it. That slide will not cause a damage to you against the inventory. And if the prices move up also, you will not lose anything beyond that premium. So just see the beauty of hedging with goods in comparison to hedging with futures. In goods, the downside is completely hedged and the upside is completely covered. But if you hedge it with futures, which we have been doing right now, in that case, your upside becomes also hedged. You don't enjoy the upside, but when you hedge it with a put, the downside is completely hedged and upside is open. Now understand, I will give you one more live example why this hedging is important. See, we all do medical, we are all doing medical insurances. Anyone who is sitting in this room, all of us sitting in this room, we are all taking medicines. What is the reason behind taking a medicine? We don't, and you will be surprised, whoever is taking a medical does not want to use it. Nobody wants to go to hospital to see whether medical can be claimed or not. So this completely means that you are buying an insurance to protect yourself. So we are protecting ourselves because life is an uncertain event. Medical expenses are uncertain events. So we are protecting them. So why not we can protect our inventories in different situations using codes, because it can lead to a completely uncertain environment. So that is why hedging is so important, and especially for our jewelers, because they are selling something at today's price, flexible prices, flexible discounts, and the delivery is taken by people after 3 days, after 4 days. So if there is a certain slide in the inventory prices, who is going to take it? So that is what leads to the buying inputs. Now let me explain another good strategy. In a volatile environment, the premiums are moving up. I explained you how the premium starts to move up. Now, if we have a physical gold with us, can we earn extra interest by writing out of the money calls? Because we can see that the physical gold is not moving up or down. It is volatile because of the environment. So it is not able to move up. Every time it moves up, we are seeing selling pressure. So how to utilize the inventory? There is a term called as call writing. So we can actually write calls which are out of the money and earn an interest of 1 to 2%, depending upon the premium and depending upon the strike price that we have chosen to sell. So at least the inventory that we have, we continue to earn against that inventory also. I think that's a very valid strategy for everyone, especially the ones which are doing a trading job and a ones who are holding a physical inventory. So this is where different types of strategies in options hedging can come in. So I'll just repeat for everyone. For especially the producers, miners, they can use the collar, where they are hedging towards the downside, and at the same time they are selling the calls out of the money to fund this hedging. Flexible pricing by jewelers. You can buy the goods today. If somebody books pricing today, you can buy goods and fix the pricing today. So if the prices moves up, the entire game is yours. If the prices fall, suppose will take care of that. And thirdly is called kiting. Basically, the inventory is getting some interest. You are making against that inventory, which is kept in that physical form. So these are the strategies which you can do. Now, one or two strategies I would like to share with you more, which are depending upon the fix. So if you can just see the fixed, you can just put the PPT of long strangle or short strangle. So if you see there are PPTs which are related to the strategies.
You're on short straddle. You're on short strangle right now.
Yeah, long strangle first.
Short strangle, right? Okay, you want to go to long strangle.
Okay. So we can discuss the long strangles. Now in an environment, if one can see in the PPT, in an environment where the volatility is down and the market is sideways. Now when the volatility is down, gold is against what to do? One idea is against the inventory you can sell calls, that is okay. But the other is that if the volatility is down, what is getting cheaper, options are getting cheaper. And gold is getting into a range. So if there is a sudden movement in gold either side, can I use options to make money? Just imagine this was never an option with us to make money if gold moves either side. So in that environment, we can buy both call and put as it is written on the PPT. We buy 29,800 oil and we buy 29,200 gold. So both are out of the money. And if the gold goes either side with a spike in VIX, whether down or up, we start making unlimited profits. So what is a change in this? The change is earlier in futures, we cannot take this call. We cannot do this strategy that I can make money either side. It goes up or goes up. In this format, in options, we have a strategy where if we feel that gold has entered into a range for a very long period, if it moves either side, can we make money for it? In that case, we can use a long strategy. The other side is short strategy. If we can go to the side of the short strategy,
Yeah.
it's exactly opposite to that. We can see that it has to be made in an environment where volatility is gone very high. In expectation of an event, in expectation of a budget, in expectation of a cut, we feel that options have really moved up. The premiums are very high, both on the call and option side. And we feel that gold is not going to go anywhere. The event may not plan that pattern. In that case, it is always advisable to sell options. Remember, when VIX goes overheated, the best thing is to sell options. In that case, you sell both call and put. If gold remains within that range, that means that event has resulted in a flat movement of gold. Suddenly, post-event, the VIX will drop very sharply and you will make money and option premium will erode very fast. So now you understand with two examples we are telling you two different situations. This was never possible if you trade only in futures. VIX coming down, we expecting a gold moving out of range, we can do a long strategy. VIX has moved up suddenly because of an event. We feel that event will end up with zero expectations, we can do a short strategy. Now these strategies are not possible using futures. So this is what I am trying to tell here is that puts or options have come in and they will become a big different game changer altogether, especially for people who are gold traders, who have physical deliveries. These things will be a complete game changer for us. Let us now move to the next slide where we can see of the taxation purpose also. When it comes basically that how the charges, basically options or future charges, how the transaction taxes on gold have become different. So if we can put that slide of taxation upon excise of gold options.
Yeah, I'll take that, Hemant. Thanks a lot for your inputs on the hedging strategies. And so while we have already taken some time, I'd just like to, end by mentioning what Hemant just said. Section 43/5 of the Income Tax Act, which, paved the way in 2013 for futures being allowed as a set-off of business income against your physical income or loss. That same benefit also covers options. So a physical bullion dealer or hedger can actually synchronize his physical books with the hedge books created via options under the section 43/5 of the IT Act, number one. The other important factor is that the tax on devolvement of options back into futures, which used to be 0.125% earlier, and as such, it was a large amount when you talk about a bullion dealer's margin. That has been rationalized to a very nominal amount today. So therefore, the to and fro cost of transacting in options has become an absolute low double-digit number. So the idea behind this session was basically to familiarize you with the various hedging techniques which are available to you. And options at MCX are a few months old in terms of gold, and we are seeing good, encouraging results. And our team is already here and will be here over the next today and tomorrow to meet. We'll be happy to address all your queries. Thank you so much for your patience, and the connectivity has been a challenge, but thank you for your patience. Thanks. Thanks, Hemant.